Hello, everyone. We wanted to take a quick moment to thank you all for joining us today. This podcast was recorded and is made available to you by Whitley Penn LLP and WP Wealth LLP solely for informational purposes. The information, views, and opinions expressed in this podcast are general in nature and are not intended to be construed as the provision of financial or investment advice by Whitley Penn or WP Wealth. The information discussed in this podcast is accurate as of the day it was recorded, but may then become outdated over time. Please feel free to contact us if you have any questions, comments, or concerns in regard to the content presented. Thank you again for tuning in, and we hope you enjoy this episode.
Welcome everybody to another edition of Whitley Penn Talks. I'm Tom Rein with Matt Magee. We visited with you about a month ago talking about the state of the market and some of the issues that we were dealing with during the height of the COVID crisis. We're about a month out and things look very different today. Matt, good seeing you again.
Yeah, happy to be here.
Yeah, the office opened up full time about a week or two ago, and it's great having all our professionals back and collaborating with them face to face. I think we've all become some experts in Zoom videos, but it doesn't replace being together and working shoulder to shoulder again.
Absolutely. Well, let's jump right on in. So our last episode was roughly end of April, and we talked a lot about volatility in the markets and what the Fed and government had been doing for the first month of COVID. So now that we're 2-3 months into it, what have you been talking with iron investors about?
Yeah, the conversations have really changed over the last month and a half. Most of the discussions we're having today with clients and really with our, internally within our group is centered around the disconnect between what we perceive the negative impacts to the economy. We hear all the data points and all the economists talking about the damage to the U.S. economy, but yet the stock market largely is back to all-time highs. And so a lot of conversations about how those two factors really are divergent, and how can that be?
Yeah, that's an interesting point. Along those lines, can you go into some detail with all the experts weighing in and unemployment numbers coming out that have largely been horrible? Last week we had a big report. I think they were expecting roughly 7.5 million new unemployment claims, and actually we added 2.5 million, and talk through some of that.
Yeah, that kind of leads into the real confusion. One, that the economists and their predictions are so off. Market participants makes decisions based on information, and so when you have that kind of gap between expectations and reality, you really got to wonder what's going on. But I think it's important to remember that the market. I think so. Instead of listening to all the experts, which obviously have been proven wrong so many times and by big degrees, I think it's important to focus on what the market itself tells us. Every day there's hundreds of millions of dollars of transactions and hundreds of thousands and millions of trades that are conducted every day by willing buyers and sellers that aren't, mandated to necessarily have to make a trade. And so I think the information and pricing it should give us a lot of indications as to what the true underlying economic activity is. And so, from the bottoms in March and really through April and May, the market has expressed an opinion about what fair value of securities should be, regardless of what the economists are saying about unemployment claims or GDP contraction or whatever the data point of the day is. And so, as a group, we really do believe that markets are efficient and that every day by the activity of willing buyers and sellers that, it does it does present fairly what the market is perceiving relative to economic activity. And that's interesting because you could say, well, if you believe that, then how do you explain what happened in the month of March, where, up until really the end of February, early March, the market was expressing an opinion on valuation, and it was fairly consistent, with an upward slant. And then, 2 or 3 weeks later, the markets are devalued by 40%. And you say, well, if markets are right most of the time, how can that happen? And I think, the answer to that is that in normal times, the markets act and work in an efficient manner, but sometimes things break. And so, largely that's what happened when the government, shut down the economic system literally overnight. That caused a break in the system. So all the normal operating facets of trade, of banking, of lending, of the capital structure got broken. And so because of that, things don't look normal. You get a situation where really the plumbing of the capital markets and the financial structure froze up. We saw this similar back in 08 and 09. And the difference between then and now is that this was a new phenomena back in 08 and 09. And so Treasury and the Fed were trying to diagnose the problem, and were much later in prescribing the antidote, if you will, to it through quantitative easing and lending facilities with the Fed. The difference now is that based on that knowledge and the success that was realized in those actions, the Fed got out in front of it. And so, they jumped out in front of the problem in a huge way, and to unclog the plumbing and to remediate the problems that the freeze up in the capital system provided. And so what we saw was, certainly when the system broke, the normal financial markets acted irrationally. There was cascading valuation decline, but the minute they unclogged the plumbing, if you will, the markets rebounded significantly, very quickly, and really got back to a point where we've been maybe for the last month and a half, where every day the market is reassessing its opinion on valuation. Now, that's not to say that we won't have further volatility or valuation change, either up or down, but that will be based on new data, new information, and the investor's willingness or ability to take that and express their opinion as to whether prices are cheap or they're expensive or they're just right. But I think, the probability of the markets suffering another significant valuation decline of 30 or 40% or what have you is probably pretty remote, because the Fed is in there. They've remediated the problem. They've given us the confidence that they're going to be there as long as the markets need, so that those plumbing problems, those defects to the systems don't reoccur and create that broken system, which creates that valuation decline.
Yeah, absolutely. I mean, you covered a ton of different topics there. I mean, on the idea of markets being efficient, what are your thoughts on people investing in these bankrupt companies like a Chesapeake, a Hertz, that are seeing huge increases almost overnight?
Yeah, it's when you get into picking names and being speculative, it's really a challenge. The broad indices have come back, but I think if you peel that back, there's certainly leadership within the indexes that are driving that valuation game. If you were an index investor or you owned a security that represented the market broadly, you did well. But if you were into picking names, your experience may be very different. Yeah. And your ride may be very different. You may have bought a Hertz or a Boeing or any of these certainly not Boeing from a bankruptcy standpoint, but they've had their own issues. Yeah. But any of the airlines or any of these other companies, the retailers that are really suffering, that roller coaster ride is significantly just based on each day's soundbite or Fed policy, and so your experience may look very different than if you own markets broadly and participated in the rebound in valuation of your securities. So very interesting times.
Yeah. If you're an investor that stayed put through March and has experienced that rebound, but is still concerned about, given that there is no vaccine yet, what are your recommendations for somebody that's kept their seat but still very hesitant, I guess, of what's to come, regardless of the Fed action and everything that's happened there?
No, that's a great question, and I think that goes largely to the conversations that we have in constructing portfolios for our clients. You have to look at what your ultimate needs are for the pool of assets, and you got to look at what the goals were and what the underlying theme was in building the portfolio in the first place. And as long as nothing's changed, then I think this was another great example, like we saw in 2000. Like we saw in 07, 09, like we saw, in April, May, and June, that as long as you don't react, that you don't change your strategy, that may be a long-term strategy into a short-term strategy, you're probably going to wind up okay. So I think it's important to reevaluate, was your goals properly aligned with your risk? Did the time frame for your portfolio and your needs for it appropriate? Are they still appropriate? You probably don't do anything if in fact that you were misaligned, that you had needs for liquidity that you didn't really plan on but now you're more comfortable with. And I'll give you an example. Our 60-40 portfolio is about break even year to date, so we essentially got back to even. And so if you were wrong and your goals have changed now, or your time frames have changed, this is probably the time that you look to harvest some liquidity and change the allocation. But just to do it to react, I think is wrong. But to do it for a valid reason that meets your needs, and I think that makes an awful lot of sense.
Absolutely. Along those lines, I mean, if a second wave were to hit this fall, winter, I guess purely from an economic standpoint, do you think they'll shut everything down again? I mean, obviously we'll be more prepared. The Fed will step in from kind of the market perspective, but I guess call it from a Texas economy perspective. What do you think might happen there?
That's a great question. I've seen some reports recently that, as things have opened back up, maybe with some of the protests and large group gathering, that some of the numbers, the cases are starting to increase again. So that's not out of the realm. I think maybe the difference now is that we had 2 or 3 months of experience on how to conduct business. So, if you shut down, you had to shut down again, or some modified, I think we're smarter as business people now and have learned how to be productive. So I don't think a lot of the initial damage was done just by, just sheer speed and panic and not knowing how to react to or interact with. I think we've gotten smarter. So I think business would continue to be productive, as we've learned over the last couple of months in a lot of the sectors and industries. Certainly some industries would be more affected, whether it's restaurant and retail and things like that. But I think we're smarter. I think people's attitudes about the virus have changed. When it was unknown, people took the most cautious and safe route. I think as the numbers materialized much lower than what was projected, and granted, a lot of that is probably because of the actions we took. I think some folks have different risk tolerances to how they feel safe or not, and whether they would be willing to be more interactive in the economy or not. So I think it would look very different. The other thing I would say is we're going into an election year, and I'd be shocked if the current administration would be as aggressive in shutting down the economy right before an election, seeing the damage that it did the first time. That doesn't mean it's the right answer. Yeah. It may be the political answer. So, I think it would look very different if the numbers started to rise materially as far as what a shelter in place or a lockdown would look like versus what we experienced back in March, April, and May.
Yeah, I tend to agree. I heard they're already talking about more stimulus checks possibly, so who knows? Yeah. I think anything's on the table given that it is an election year. So you've been in the business for a few years and had the pleasure of working with a number of different investors. what advice do you have for somebody that might be putting new capital to work where we stand today in June?
Yeah, risk reaps rewards over the long term. I think there's pockets of valuation opportunity that still exist. I think the Fed, through their actions, took a lot of those opportunities away by adding essentially puts to downside. But there's still pockets of valuation opportunity out there, and I think the biggest is just the amount of liquidity that not only the Federal Reserve and the Treasury, but also central banks around the world are pushing into their economies or to the economy at large. What we do know is that historically, it's been a direct correlation that when central banks are in an easing mode, whether it be interest rates or straight out liquidity measures, it typically pumps up asset values. So you're sitting today with, in the U.S. economy, they talk about annual GDP of 40 trillion. In a relatively short period of time, we pushed $10 trillion either in Fed lending opportunities or stimulus or in government interaction, and largely in a zero interest rate environment. Investors want to search for areas where they can get return, and so I think the equity markets are going to get a lion's share of that, as would some other opportunities that might exist. Even as bad as energy was, I think there'll be a lot of consolidation and a lot of investment in energy going forward, as it seems like Saudi Arabia and Russia have kind of put their feuds on rest and have come to an agreement on production cuts, and as we will begin to see demand starting to increase as the economy opens up. So I think there's opportunities, but I think certainly you can't ignore the amount of liquidity that is washing around in the economy, and a good part of that is going to find its way into some investment theme, which will drive prices higher. So that's got to be optimistic from an investor's perspective.
Yeah. I mean, you've hit a ton on liquidity as well as interest rates there. I think the Fed just announced they're going to keep rates at pretty much zero for at least the next 2 years. Like, does this house of cards pretty much come down as soon as they start raising rates, or what are your thoughts on that? Like, do they just have to indefinitely keep them this low, or?
Yeah, that's another great question. We saw after the financial crisis, the Fed expanding their balance sheet and keeping interest rates low, and they had a really tough time exiting from a lot of those programs, many of which they never exited from. For all intents and purposes, they kept their balance sheet at the level they built it up to $4.5–5 trillion, and it really didn't shrink the balance sheet. They tried to move interest rates a bit, and the economy and the market really bucked that every time they tried to do it. So, you take what happened in '08 and you put it on steroids now relative to size. I don't think it's reasonable to assume that there's a graceful exit out of that. I think in the short term they really didn't have any choice. In the long term, there's no free lunch. I don't know what the price to either the economy or to lifestyle or to what spending another $8–10 trillion means. It's probably a future generation that feels that. If debt didn't matter, we'd be spending unlimited since the beginning of time, but we haven't. I can remember when Congress would threaten to shut down the government to raise the borrowing limits, and you're talking about $500 billion or $250 million. They're raising trillions every other day, it seems like. So the numbers are just staggering, and again, it has to have an impact. It's not clear today what that will be. Today we're just trying to save the economy, but somewhere down the road there's got to be a price to pay, and there's got to be some pain that's felt on that as well. So yeah, really interesting topic.
Absolutely. Well, would love to wrap up with any final thoughts for investors on what to expect for the next 6–12 months from an economy standpoint, Fed, the election, civil unrest. There's pick your topic.
Right?
Yeah.
Wow, there's a whole smorgasbord of just topics that would stand on their own, but they're all happening at the same time. I guess over the next 6 months, what I would say is as we get into the election, it's clear, and it doesn't, I'm not expressing an opinion on politics, but it's clear both parties have no problem in spending. I don't know that there's such a thing as a fiscal conservative any longer. You give them an opportunity or a reason, they'll spend. I guess the beneficiaries of the spending really will differentiate between parties. Who benefits from all this spending, but spending will continue. There's no better way of being viewed positively to an electorate than to be giving money out. So I don't think that ceases. I think we'll probably have another round or more rounds of government funding to help mitigate the damage and soften the blow that many businesses and individuals have faced because of this. It'll be really interesting as to the debates over policy, both that has been instituted over the last 3 or 4 months, but prospective policy and what the talking points of the platforms will be for both parties. And so, again, I think more liquidity, which means probably higher markets, which means more subsidies and dependence on big government. And we will see what the voters think of that in November. And the next administration, whether it's Trump or Biden, will have lots of tasks and lots of challenges ahead of them over the next 4 years plus. So stay tuned. It'll be an interesting ride, and obviously we'll be gleaming as much information from it as possible to help make decisions for our clients and continue to be their advocates to make sure that we accomplish the goals that they've set out for themselves. So,
yeah, thanks for tuning in.
Great. Thanks, everybody. I hope you enjoyed this WP Talks. We'll be back with new topics over the next several weeks and through the summer, so stay tuned, and we'd love to have you join us again. Thanks again.
Thanks.